All right, let's dive in. Today we're exploring a world that's usually hidden in the shadows: tax havens. We're going to break down how this incredibly complex global game is played and, more importantly, how the rules are changing, literally as we speak. You've probably wondered about this, right? It's the multi-trillion-dollar question. How do some of the largest, most successful companies on the planet legally manage to shrink their tax bills, sometimes down to almost nothing? And look, the answer isn't some simple trick or loophole. We're talking about a sophisticated, globe-spanning strategy, a high-stakes game played across dozens of countries. But here's the real kicker. The entire rulebook for this game is being torn up and rewritten right now. So, to really get what's going on, you gotta picture a giant global chessboard. Companies strategically move their pieces, their profits, their assets, all over this board to get an edge. Let's start by understanding how the old game used to be played. For decades, the game was pretty simple. A company could make a ton of money in a high-tax country, say Germany or the US, and then, completely legally, shift those profits to a place with a way lower tax rate, or maybe even a 0% tax rate. Okay, but here's where it gets really interesting. Not all of these low tax spots are created equal. Just calling all these places tax havens doesn't really cut it. It's way more nuanced than that. It turns out there are a few different types of players on this chessboard, and each one has its own unique playbook. In fact, we can pretty much sort them into three main buckets, or flavors, if you will, based on their specific strategy for attracting business. And understanding these three types, that's the real key to seeing the big picture. All right, so think of this slide as your cheat sheet for the whole setup. It breaks down into our three flavors. First, you've got your zero-tax OFCs, like the Cayman Islands. Their pitch is as simple as it gets: no corporate income tax, period. Then you have the territorial hubs, like Singapore. They play a totally different game. They'll only tax you on profits you make inside Singapore. Money you make elsewhere can be tax-free. And finally, the EU hubs, with Ireland as the classic example. They use their membership in the huge European Union to offer some really unique tax advantages. Let's zoom in on each one. Okay, let's zoom in a bit. We're going to put these different players under the microscope, starting with the one that probably sounds most familiar. First on the list, the one you've probably heard the most about, the Zero Tax Offshore Financial Center, or OFC. And the poster child for this is the Cayman Islands. Their main selling point is super simple, but man, is it powerful. Their whole model is built on the number 0% corporate tax, 0% tax on capital gains, and, this is a big one, no withholding tax. See, that's a tax countries normally slap on money when it's leaving their borders. By getting rid of that, the Caymans make it a totally frictionless hub for huge investment funds and for companies to zip money between their different divisions. All right, next up, category 2, the territorial hub. Singapore is the perfect example here, and its approach is much more subtle. It's less about being zero tax and more about being smart tax. So how does this smart tax thing work? Well, it's pretty clever. Singapore taxes profits made in Singapore. But if your company there earns money from another country, that income can often be tax exempt. On top of that, they roll out the red carpet with awesome incentives for companies to set up their real regional headquarters and to develop valuable intellectual property like patents and software right on their soil. And that brings us to our third and final category, the EU hub. And you really can't have this conversation without talking about Ireland. Its big advantage comes from mixing a low tax rate with killer access to that massive European single market. Yeah, everyone knows about Ireland's famous 12.5% tax rate, right? But the real magic, the secret sauce, is in the fine print. They've got special programs like a knowledge development box, which gives an even lower tax rate for profits from R&D done in Ireland. Plus, because they're in the EU, companies there can get payments from, say, France or Germany without getting hit by those pesky withholding taxes we talked about. That's a hugely powerful combo. So for years, companies used a mix and match strategy with these three types of places to build their global empires. But then, everything changed. I mean, the game was completely upended. A massive global compliance crackdown started, and that old playbook got tossed right out the window. And honestly, it all comes down to these two words: economic substance.
This is the new golden rule, folks. It means you can't just have a P.O. box and a nameplate in a country anymore to get their tax deals. No way. You have to have actual offices with real people at real desks making real decisions right there. This slide just lays it out so clearly. The old way was the brass plate company, literally just a name on a mailbox in a building somewhere, where secrecy was the name of the game. The new way demands substance. You have to prove you're really there. It's a 180-degree turn from secrecy to transparency. The old way is dead.
And if that wasn't a big enough change, then came the real bombshell, all summed up in this one number, 15%. Over 130 countries got together and agreed to a new global minimum tax for big corporations. This basically puts a floor under the whole system, and it means that no matter where a huge company books its profits, it's going to pay at least a 15% tax on them. For the world's biggest companies, the zero tax strategy is officially a thing of the past.
And make no mistake, this isn't some friendly suggestion. This is a massive, coordinated global push. We're seeing huge international projects like BEPS, which, by the way, stands for Base Erosion and Profit Shifting, that are designed to do one thing: stop this kind of tax avoidance. You combine that with things like the EU's public blacklists of so-called non-cooperative countries, and you can see the pressure for transparency is coming from every single direction.
So, okay, the old game is over. The board's been flipped. How on earth do you win the new game? How do businesses even begin to navigate this completely new world? What it all means is pretty simple, actually. The playbook has been totally rewritten. I mean, strategies that were literally textbook moves just a few years back, now they're either totally useless or just way too dangerous to even try. So, what's the new playbook look like? Well, it really boils down to three core principles. First, you've got to match your function to the benefit. Want to use a country's R&D tax credit? You better have your scientists actually working there. Second, model for the new rules. That 15% minimum tax changes everything. All the old math is out the window. And third, reputation is now everything. Being linked to a blacklisted country is a huge business risk. It can even get your bank accounts shut down. Look, if there's just one thing you remember from all of this, let it be this. The age of the mailbox company is over. It is now all about demonstrating real economic activity performed by real people in real places. And all of this leaves us with a really fascinating question to chew on. In this new global economy where transparency is the new currency, it's not just tax strategies that are becoming obsolete, it's entire business models. So which ones are actually built to thrive in this new world? And which ones are basically dinosaurs, just waiting to go extinct?